Hey, good morning, everyone. Marty Missouri here, October 8, 2019, Tuesday. Just a quick call it a pre-market update for you. It's about a half hour, a little more than a half hour before the open this morning. Therefore, we're going to look at the S&P 500 futures chart. A lot going on today. A lot going on this week. A lot been going on lately, and some of it market impacting, some of it not. Of course, we'll focus on the market impacting stuff. So again, in front of you is the futures chart daily for the S&P 500. Let me zoom in a bit here. So we spent a lot of time back in August right in here. That trading range that we were stuck in for a month, and we just kept hitting this level up in here, or coming close to it, and that's that resistance level, even more defined on the S&P index, the cash index itself. But yeah, same thing going on here in the futures market, of course. And so here we are now, really battling with both this resistance line and this trend line right in here. So you can see, folks, we have this zone in here where traders are really pushing the ball back and forth, if you will. So remember a week ago, last Thursday and Friday, we had this downturn. I said, look for a bounce early in the week. We did get one. We got a pretty good bounce on Monday. Then we got the ISM manufacturing survey that was really ugly, worse since the Great Recession. Follow through on Wednesday. Tried to rally early Wednesday morning in the futures, opened right here. Then we went plummeting down on the ISM services survey on Thursday. Then suddenly the narrative completely flipped. Right in here, I think I even said on the written blog, looks like finally bad news is bad news for stocks. Well, for whatever reason, sentiment really changed in here. Probably some commentary from the Fed, although I didn't catch any on that day. But clearly the narrative flipped, and suddenly all this bad news means this Fed is really going to engage and get aggressive, reducing interest rates, opening up new quantitative easing, and so on. So as that narrative flipped, money came rushing back into the market. Plus, again, we were hitting some pretty key technical levels. We bounced off of here the day before, then again came close to it. Closed above this trend line, opened right on it, and so we also had some technical factors coming in here. There were some bulls ready to engage if we got a bounce off this trend line, perhaps. Then we came back, and actually all the way back through, I had said as we penetrated this that this was really bad news because there's nothing worse than a failed bullish breakout. And then lo and behold, a couple days later, here we are closing back above this line. Then came yesterday, where we spiked a little bit lower at the open, came rallying back, looking pretty good for quite some time, then came back and closed just below that trend line. Not a good sign. A lot of selling there late in the day. I wrote about that last night. And here we are this morning, folks, in the futures market, coming back down into this range in here. Not a good sign for the market if it cannot hold up against that particular resistance line. Like I said back in here, that's a bearish sign. And to give you more of an appreciation for what's going on right here, let's take a look at the 4-hour chart where every candle is a 4-hour candle. See, again, here's that resistance line. Look at the market just having a war right here. The bulls against the bears, and then looks like the bears are kind of winning the battle here, at least in the very immediate term. Zoom out a little further to the 1-hour chart, even more pronounced right in here. Look at all that action right in there along that line. Just again, bears pushing back against the bulls. So folks, there may be some news headlines here and there, maybe not. There's an overall general bias or prevailing bias, which I still have to say is overall up. But you can see there's some pretty passionate bears coming in up in here right now at this level, trying to turn that bias around, and that looks likely when I show you the longer term momentum indicators that I pop in with from time to time. 30-minute chart, look at that. Again, I think you get the point. 15-minute chart, just right there is where we're living, failing off of there. This, by the way, if you like the technicals at all, this looks like what would be a bearish flag pattern right in here. This is a continuation pattern, at least on the 15-minute chart. So we come down, move sideways for a bit, form what looks like a flag when you kind of put your barriers around it. And then there are bullish flags and there are bearish flags. If this plays out, you look for it to break out below, and your target would be the distance of the flagpole. So if we did break out below here and you were to measure that, you'd go down another good chunk. If this pattern does play out, certainly doesn't have to, but if it does, then we're going to be threatening the August lows. We break through there and things can get pretty ugly on a technical basis. So again, coming back to the daily chart, ISM manufacturing data, weak. ADP jobs data, weaker than expected, very weak relative to expectations. Services ISM survey, weak jobs numbers relative to expectations on Friday, but again, fostering the notion that this Fed is going to come in and save the day. Today, it's mostly about China and the trade news. I was surprised last night, frankly, in the futures market that futures in the evening were actually trading nicely higher. I was surprised because the news that I was getting was that the US blacklisted a whole raft of Chinese companies. The fact that they're doing that on the week that China is coming, it suggests that maybe the game is changing a bit. Not that the US hasn't used that tactic, and that is to, push and threaten and try to get a good deal with intimidation. But China has already announced that they're coming with a proposal that is very narrow relative to what the US has been demanding. So the president, 2, 3 weeks ago, kind of intimated that a limited deal would be possible. Lately, he's been saying no, it's a 100% deal or nothing. China's coming in with maybe a 50% deal. So we have to start thinking about maybe the game is changing. Maybe we're looking at a no deal scenario, and that politically will play against a very weak stock market, laying blame in various places and so on, and try to survive politically amid a real weak financial market backdrop. And I'm saying it that way, folks, because that's what we get in an all-out no-deal scenario with China. The other thing that suggests that maybe we're going there is that this morning there's news that indeed the U.S. is looking at capital controls on U.S. investors. You remember a week or so ago, the market rolled over a bit on news that the U.S. was really looking to limit U.S. investors' ability to invest in China. And one of the things that scared the bejeebers out of the market was this notion that we would delist Chinese companies. Well, folks at the White House who would definitely be instrumental in those discussions said absolutely not. That's fake news. Well, today we're right back at it. In fact, even with more details, looking at limiting pension funds in the U.S. ability to invest in China via ETFs and so on. And that makes things really messy because MSCI, for example, is just bringing Chinese companies in a big way to the emerging market indices. So yeah, it's fascinating to watch this play out. We know one thing, though, and that's pretty definite. China's not going to give the U.S. what it wants in terms of limiting state subsidies and curtailing China's longer term ambitions in terms of the China 2025 initiative and so on. They basically just drawn a line in the sand there. And for Bob Lighthizer, the U.S.'s chief trade advisor, those have been requirements to do a deal. So I could speculate in terms of what's going on in the minds of the players, but let's let things develop. I don't want to speculate too much here. But at the end of the day, folks, aside from this concerning, let's call it rhetoric right now, the underlying fundamentals that I've been illustrating for you, things that are showing up in our own index, things that are showing up technically in the charts and so forth, just don't look good. So again, the fundamentals vis-a-vis the economy, the data that we think is important and that we track, doesn't look good. Looks more like periods where we're rolling into something ugly than it does periods where we have a sustainable move higher. And the technicals are showing that as well. That's that heaviness that I've been illustrating for you. So right now, hedging portfolios with options makes the most sense to us. So we're going to continue to do that on our client portfolios going forward, where we can, that is, and let things play out a bit longer and continue to update our assessments as we go. Thank you, as always, for watching and listening. Look for a great deal of volatility, I'll have to say, in both directions for the foreseeable future. Talk to you soon. Bye-bye.